Welcome to Capital Link's company presentation series.
Welcome to Capital Link's company presentation webinar series. In this series, senior management of listed shipping and maritime related companies provide an update on their operations, business development, strategy, and sector outlook. I am Nicholas Bornoulis, president of Capital Link. Capital Link is an investor relations firm also active in event and conference organization. We work with several private and publicly listed companies, including companies featured in this webinar series. As noted in our disclaimer, these presentations are purely for informational and educational purposes. They do not constitute investment advice or advice of any kind, and obviously Capital Link bears no responsibility for them. Today, we have with us the senior management of Eneti. We have Mr. Robert Bugbee, President and Director, Mr. David Morant, Managing Director, Mr. James Doyle, Senior Financial Analyst, and Mr. Sebastian, Brooke, Chief Operating Officer of Seajacks. The whole session will be 45 minutes. We will start with a brief slide presentation, followed by a live Q&A session. Please submit your questions through the Q&A button at the bottom of your screen, or email them to us at webinars@capitallink.com. David and Sebastian is going to take us through the presentation, and then James and Robert will be joining for the Q&A. So, David, I'm turning it over to you, and Sebastian.
Nicholas, thank you very much. Thank you again to Capital Link for hosting Eneti. We're excited about the opportunity, we think, to present a very unique story to the New York Stock Exchange equity market. I hope over the forthcoming 20-25 minutes of this presentation, you'll be able to understand the magnitude of the transition this company has been on, and the process we have taken to become the world's largest wind turbine installation vessel company, a position that we're extremely excited about, given the significant inflection we predict in offshore wind on the US Continental Shelf and around the world. And so without further ado, Eleni, if you could open the presentation and display it on the screen, please. If we move to the next slide, I'm obliged to draw your attention on the second slide of this presentation to certain disclaimers and safe harbor statements around driven by the SEC and our New York Stock Exchange listed status. Next slide, please, Eleni. So the first question here is, why wind turbine installation vessels? We believe several things are starting to pass, and we've been on this project as an organization for nearly 3 years, and in that time we've only seen a strengthening of the backdrop in terms of the thesis which has driven our substantial transformation. Wind is becoming, offshore wind in particular, is becoming a global, scalable and cost competitive source of clean energy, competitive not just with other sources of carbon-free energy, but increasingly with hydrocarbons. The industry growth that we perceive, we think, is almost second to none. It's not cyclical, it's driven by policy, it's driven by strategy, it's driven by financial economics, and it's increasingly global. What has driven that, if you look to the bottom left of this slide, is the significant increase in turbine size. This has gone from a very small regional industry, predominantly in Northwest Europe and predominantly in the early parts of its evolution onshore, to an industry which is now achieving industrial scale and providing real grid scale power solutions. Within that context, the clear bottleneck that has opened up is the maritime supply chain. Put more simply, whilst these projects are well through being on the drawing board, they're mandated, they're through FIDs, and they're politically important to and economically important to their backers, there's limited vessel supply to meet what we can now see as a significant step up in demand. From our position, therefore, as Eneti in the supply chain, we now believe we are very well positioned to capitalize on this significant growth, providing a vital part of the supply chain that has very little, if any, substitutability, and where there is demonstrable underinvestment in terms of vessel supply. Next slide, please. The reason we are so excited about the position is, despite the importance of wind turbine installation vessels, They're a very, very small part of the overall cost curve. Put more basically, there are billions of dollars of capex running up and down this supply chain. And within that, wind turbine installation vessels occupy an extremely important tolling position in the supply chain. The pricing power that we have relative to the significant capital dollars being invested, we believe is unparalleled. And we believe the opportunity, therefore, to have high quality, predictable cash flows between now and the end of the decade for our company is substantial. Next slide, please. So the company at a glance, we are, as I mentioned, the world's largest player in this market with 5 modern vessels on the water and 2 vessels that we have ordered from DSME for delivery in the late part of 2024 and early part of 2025. That makes us the preeminent company and, importantly, the only New York Stock Exchange listed play on what is one of the most substantial transformations in the world's energy mix. In May of last year, we ordered our first NG 16000X. That is a next generation vessel, one of the most powerful vessels in the world that will be capable of fitting the 12 to 15 megawatt turbines. And we confirmed our second option in December following a $170 million capital raise that we executed in November. Most importantly, though, in August of last year, we announced the acquisition of Seajacks, one of the longest established and most significant players in this industry based on the east coast of the UK. That brought us not only substantial operating pedigree, represented today by Sebastian, one of the most experienced executives in the space, but also an important slate of strategic shareholders in the form of the Japanese sellers, Marubeni, INCJ, and MOL. And on top of that, a burgeoning fleet of high quality vessels and a significant revenue and EBITDA backlog. Next slide, please. So 2021 was our transformational year, and we sit here now on the New York Stock Exchange, ready and prepared for the growth, a highly profitable company, a company with a rebooted balance sheet, with an exciting new build program, an experienced management team from Eneti and from Seajacks, and a huge opportunity in front of us for our shareholders, many of which are either selling insiders or from the previous ownership of Seajacks, and or management and our significant backers, the Lauro Ligeti families. Next slide, please. With this, I'll turn it over to Mr. Sebastian Brooke, our Chief Operating Officer at Seajacks, who can run you through the existing fleet and our exciting new build profiles. Sebastian.
Thank you, David. I think we've been through a brief history of Eneti and their fairly recent introduction to the offshore wind space. But through Seajacks, they've acquired a company that has quite a lengthy history of operating in offshore wind. The company was started in 2006 and took delivery of our first 2 vessels in 2009, and in fact installed our first turbines in 2009. We were originally public and listed on the Oslo Athens Exchange, were acquired by private equity in 2010, and in 2012 sold to Marubeni Corporation. 2021, as David mentioned, we were acquired by Eneti. At each stage of our development, we've had owners that have contributed capital to enable us to enjoy or to benefit from the growth, or the growth in offshore wind, and Eneti is no exception, and they've already ordered 2 exceptional vessels at DSME, which we look forward to operating alongside the rest of our fleet. With regards to the vessels on the water, currently we've got Scylla, who's perhaps the most advanced turbine installation vessel in the world. She's installed both foundations and turbines, both in Europe and Asia, and is starting actually in the next couple of months, probably one of the most high profile projects globally, which is the Greater Changhua project for Ørsted. We recently announced we've also secured further backlog for her, and that 2023, we expect 2023 to be filled with work back here in Europe. With Zaratan, we have a vessel that is flagged Japanese, which is the only way you can really work in Japan. Japan is a high growth market, and Zaratan is currently installing the first commercial wind farm over there. Going forward, we see that there's a significant undersupply of vessels, and as I said, high barriers to entry for foreign flag vessels. And so we look forward to benefiting from this market discrepancy or the limited supply in this market, both through installation work, geotech work, and various others. And of course, being located in Asia Pacific, just because she's Japanese flagged, she is also capable of working in the other growth regions in that area, for instance, Taiwan. The 32500s, the smaller vessels, they installed a very large portion of the 3.6 to 4 megawatt installed capacity in Northwest Europe, and they are benefiting from and will continue to benefit from increased volumes of O&M work as these turbines get through a meaningful part of their design life. A lot of them were installed maybe 10 years ago. And then obviously on the right-hand side of this chart is the new build vessels, like I touched on earlier, 2 of them under construction, and Seajacks is very much looking forward to applying its operating know-how, its operating expertise, and its client base alongside these new assets. Next slide, please. Like I mentioned in the last slide, we do have a long provenance of installation at Seajacks. And I'm pleased to report I've been working there since its inception in 2009, and many of our key personnel have been in there for the majority of their working career. We have very high retention of these experienced personnel who we tend to bring in at a young age and educate into the ways of offshore wind, and we run a very tight kind of family at Seajacks. We have benefited not only from installing wind turbine generators, up to 500 of them, but we also have exposure to the foundation installation market. So we've installed up to 450 foundation components, in addition to substation works, commissioning of the ancillary equipment that's required in these offshore wind farm installations. In addition, as a result of our kind of long pedigree in this history, we have the ability to contract our vessels on slightly different charter regimes. So we're not just limited to time charters, but we have the experience to be able to contract on T&I basis, transport and installation basis, which is slightly more sophisticated contracting structure, depending on what our clients prefer or what their preference is. So that again gives us a kind of broader reach within the opportunities that are in the offshore wind sector as a whole, both on the foundation and on the turbine installation side. Next slide, please. This is just a snapshot of some of the major clients that Seajacks has worked with over the last 10 or 15 years. And I think maybe the most notable thing is that while this shows established players in Northwest Europe, many of these names are very established in all of the other growth regions of the world. So you'll see the Ørsteds of this world are not only the primary player in Northwest Europe, but also in Taiwan, for instance, and also in North America. Seajacks has relationships at all levels of these developers, from an operational level up to the executive level, and in many cases has signed contracts for high-profile Asia-Pacific contracts with the same individuals that we've signed these contracts maybe a decade ago with in Northwest Europe. So we're very well established within our client base, and continue to negotiate contracts in all these growth regions with these core clients. Next slide, please. I think one of the characteristics of Seajacks, which I think as an organization we're most proud of, is our global footprint. We were a first mover in Europe. 2009 was when we put our first turbines in Europe, and we've also been a first mover in in the Asia Pacific region. In 2019, we took the strategic decision to move one of our vessels to Asia Pacific, and as a result of that, installed the first commercial wind farm offshore Taiwan. This year, or last summer, we completed the foundation installation at the Akita Nishira project, which is the first commercial wind farm in Japan. So Seajacks has been at the forefront of the industry and has an established foothold in the growth regions, which I think will serve us well for the future. Because in addition to Europe and Asia Pacific, we also have a foothold in North America, where we have been looking at and pursuing quite aggressively the North American market. This also has tough barriers to entry with Jones Act requirements, but Seajacks has last year established a construction supervision agreement with Dominion Energy for the first and currently the only Jones Act vessel that is under construction in America. So again, I think that over the last 10, 15 years, we've established a global footprint, and we look forward to benefiting from that in the future and being able to benefit from the changes in utilization, demand, supply, and opportunities that come on the day rate side in these various markets. Next slide, please. And on this slide, I think I'll hand over to David, if that's right.
Thank you very much, Sebastian. I just wanted to take a step back to the start of our thesis point and provide a further level of information and detail around the availability of vessels, particularly for these transformative 12 megawatt plus turbine fields, which are now coming down the tracks from 2025 onwards. And what you can see here on the bottom left chart is that supply demand for all turbine sizes and vessels is in pretty good balance at this point. In fact, the industry, given this enormous wave of capex that is coming, is at a slight hiatus in front of the significant build that we project from 25 and 26 onwards. But if you look on the right-hand side, this only tells half of the story. If you look at the supply demand for 12 megawatt projects and up and capable vessels, you can see that the industry is in even more substantial deficit, particularly by 2025. And I would remind you that with around a 36 to 39 month build time at these yards, that 2025 vessel supply number is starting to become a reality rather than the modeling assumption. This is what drives the power of the incumbency, the predictability of the cash flows, and the equity returns that we project on our substantial new build projects. Next slide, please. I want to spend a moment talking about the US Continental Shelf, because I think it is pretty hard to overstate the transformative impact of offshore wind over the forthcoming 5 to 10 years along the east coast of the United States. It's no exaggeration to describe this as probably one of the most fundamental revolutions in the US energy mix since the US Gulf of Mexico opened up in the 70s. And you can see here along that east coast, the most substantial investments, many of which are becoming a reality. Empire and some of the announcements we've seen from Skipjacks, Ocean Winds, to name but a few. And of course, the vessel that we're working on and where we are the consultant to Dominion Energy, currently under construction at Brownsville. On the left-hand side here, you can see the significant ramp up in projects. You can see the focus of these at 12 to 15 megawatts and up. And you can see further that these are effectively announced projects. So don't misunderstand the back end of the decade in terms of a fade. We expect to see these projects continue to ramp out to the end of the decade and beyond. This isn't cyclical investment, this is structural, it's politically mandated. And for the first time, we're also seeing major energy companies come to play. So this has gone from being a private equity led sector, 5,500 turbines already in Northwestern Europe versus the 7 we see on the US continental shelf. But make no mistake, this is where big money and big energy companies are coming to invest their dollars. As the CFO of BP was recently quoted as saying, upstream is now an offshore wind farm, not an oil field. Next slide, please. So against that backdrop, I want to just spend a moment talking about our strategic evaluation of a US Jones Act compliant wind turbine installation vessel. Many of the things that we've talked about here in terms of structural growth, predictable and tangible undersupply, reach their apogee and their high point in the context of the United States market. And you can see here the demand for vessels that we project right the way out to 2029, 6, 7, maybe at peak in 2027, against the backdrop of which there is only one vessel currently under construction. We believe that the defined regulatory moat provided by the Jones Act in the US, further tightened in its application by the Biden administration, provides us with a clear incentive and opportunity to build a vessel with very high levels of return and utilizations and extremely rapid asset paybacks. We continue to evaluate this project as we announced at the time of our equity raise late last year, and we expect to have news to come through the early part of this year. Next slide, please. So to sum up, we believe Eneti provides unique access to a high growth industry. This is an industry which is really starting to take off globally, and no more so than in the United States. The United States is intending to build around 30 gigawatts of offshore wind between now and the end of the decade. and we think that is really just the beginning. The ScotWind Round 4 license that was recently announced in isolation a further 25 gigawatts of capacity around the Scottish coast, and we're seeing new territories come in from Vietnam to Taiwan, Korea, Poland, the Baltics, and as I mentioned, the emerging markets in America as well as the United States. So against that backdrop, offshore wind has come of age as a strategic source of grid-scale energy, and we are determined to play our part in the global build-out of that. So to finalize, the company is focused on maximizing its shareholder value. We have increasing contract coverage, a high-quality installed asset base, an experienced management team, and high specification new builds coming on time, increasingly on budget with high teens asset returns in a predictable top-down revenue environment out to the end of the decade and beyond. With that, I will conclude. Thank you for your attention and turn this back to Nicholas Bonosis for questions and answers of the management team.
Well, thank you very much, David and Sebastian. And now we are joined by also Robert and James for the Q&A. So this has been a very popular presentation, and also I can attest to that based on the questions that have come through. If you don't mind, I will try to group them as much as possible. Let me start with Robert. Robert, this has been a significant transformation of business from Scorpio Bulkers. What attracted you to this space and to this story initially? And what have you done? How have you gone about making Eneti a serious incumbent in this space?
Sure. Nicholas, first, thank you very much for Capital Link, to provide this forum. We really appreciate it. I think that what attracted us to this space was the future. The way that the future was going and the way that the future was accelerating, and that from the first moment we started to look at this space, it sort of portrayed a couple of curiosities. That demand grew almost regardless of what the stock market was doing, what interest rates were doing, what various economies were doing, or what oil price was doing. I mean, demand continued to grow whether oil price was minus $20 or $100. And that's the same as we've seen in this last year. And I don't think that I've ever seen in my working career, and I've seen many demand slides that start from the bottom left and go to the top right in the future. But I've seen very few that when you look at those projections again a year later, you're actually moving the whole curve up. And you did that consistently, over 3 years, and we're actually still doing that. So that's sort of the first part, is it's something that's into the future at that point. The second part was that it's a part that does have barriers to entry. I mean, it's once you're in it, there are barriers. And, the barriers start with there are not many yards in the world that can build these vessels. The second is there's very few operations really matters. So, that helps. And that sort of, was a good place. We'd had a lot of experience in building vessels, many different types of vessels in the Scorpio group, on time, on budget, very strong relationships with the Korean yards, particularly Daewoo, where we've ordered. And our first task was to go out and find the people aspect of it. And as David said, I mean, Seajacks, Sebastian, I mean, incredible pedigree. I mean, it's always difficult to stand there and say the best, but they really are the best, and they can do that on the actual record itself. They're very diversified. I mean, the Seajacks has had great experience in all of the continents of the world that wind is actually at present. They're first into many markets, and so we're very happy with that as a start, and that's creating a great platform.
Thank you very much. And if I can continue with the next question to you, what response have you gotten so far from US-based investors to the Eneti story?
I think I think you can see by the attendance and the participant attendance on this is that the first response we've got is great curiosity. That's the overriding response, is what is happening, what is changing. I mean, in the US, of course, the US is a little behind in renewables. It's a little behind in offshore wind. It's more of an international thing. But the US in the last months have shown tremendous curiosity. For Scorpio, I mean, for Eneti specifically, we already have 2 or 3 solid shareholders based in the US. There's there's not a week that goes by that we're not meeting 2 or 3 more. I think that the US needs us to execute a little bit. I think that the next 2-3 months are going to be very, very important. I think that once we close on for example, financings, once we've got a balance sheet that we can show is fully funded for a long time, once some of that'll then follow very quickly with greater analyst coverage, and probably we'll add 1 or 2 US analysts too. And then I think that as we prove that through, I think that will follow, that the general interest and curiosity as we start to perform and execute and show that will ultimately translate into more share purchase activity.
So last question for you, Robert, and then I'll go to our other panelists. What are the barriers to entry, and why are you well positioned to make them work?
The first barrier, well, I mean, I don't know the order of it, but the barriers to entry are, it's pretty significant. That this is not a bulker. I mean, it's not a tanker. There are very, very few yards in the world that can build these new generation turbine vessels. So that's the first barrier to entry. The second barrier to entry is it sort of needs it needs an experience. It needs a confidence in doing new building, projects itself. The third is, as I said, probably the most important thing of all, is that this is not something that you can just overnight build, go out, buy assets, and then hire a bunch of people. There are, the customers themselves put great stress on experience, quality, and proven service from the different groups of companies. Those are the primary barriers to entry, along with a financial barrier to entry. They don't come at a cheap price, and earnings don't come until later. So, if you imagine if you're just going in to buy for the future, you won't have any earnings, any EBITDA for 3.5 years until a vessel actually delivers to its first income. And that's quite an inhibitive barrier to most participants. So you have to be looking at this as an investment, as opposed to a quick flip.
Robert, one of the questions that have just came in, it says that none of the top 25 private equity firms in North America have invested in wind turbines in the last 15 years. So what is the different approach that you are employing?
Sorry, I don't understand the question. The question is, none of the private equity firms have invested in turbines, in wind turbines
in the past 15 years, and what is the different model that you are employing at Eneti? I don't know if that's a relevant question.
I don't know. Well, you can do, but my first comment was that's extremely encouraging. I didn't realize that. I mean, if they haven't invested, that's a good sign. I don't know how to answer that, but David, please have a go.
Well, I'll have a go. I think I understand maybe what the question is driving at. I think there's a couple of things to pull out of it. The first thing is that we've focused here on the supply chain. So there are clear risks being taken up and down this supply chain, whether it's development risks, technology risks with the turbines. We've gone very clearly for part of the supply chain in terms of the maritime chain, where we feel we have the expertise to deliver a vessel on time and on budget. And on top of that, a vessel which is a must-have tool for the billions of dollars flowing up and down this supply chain. In terms of the involvement of private equity, again, almost to echo Robert, this is an industry which came of age through Northwestern Europe. The first offshore wind turbines were put off the coast of Denmark back in 1991. So this is an industry which has been around, believe it or not, for well over 30 years. And through that period, there's been significant change. But our view is that this is really now starting to inflect because of those size of turbines. You've seen consolidation of the turbine manufacturers from 35 OEMs effectively to 3 major players, GE, Siemens Gamesa, and Vestas. And you're now also seeing the big energy dollars come to play in this market. So as Robert said, the US is arguably behind, but ironically, it might be right on time because it's coming into this sector just as grid scale solutions and really durable power solutions are starting to come about. And I think, make no mistake, if you're sitting in the tri-state area today, if New York, New Jersey, Boston are going to be powered by renewable power, they will be powered by US offshore wind energy within the next 5 to 7 years. And the change that we're about to see is material and is radical. And I think the parallel really here would be taking the US back to 2009, where Germany was actually the world's largest solar market because of the feed-in tariff off the rooftops. And in many ways, solar energy did not receive much of a reception in the United States. And we all know how that ended and the significant part that solar plays now in US energy mix and in terms of listed and quoted stocks. So our view is that we are early. It's a little lonely right now on the New York Stock Exchange. We've even had to persuade Bloomberg to create a category for the company, but we don't believe that makes us wrong. And we think this is a story which is going to play out very powerfully, particularly along the northeast coast of the US over the coming few years.
I'd just like to add sort of here that, look, we're really excited about about the actual prospects here and the value to an investor of purchase of the stock now. It's quite incredible. And I speak for myself. I've been, quite a active buyer in the open market of NETI stock, and I'm doing that because it's very rare to see in the broad maritime space or any space a situation where a company is trading at 40% of its breakup value, 30% of its replacement value. I can't imagine the discount to the actual forward potential multiples on EBITDA when the vessels are delivered, and at the same time is cash flow positive and is making an actual bottom line profit. That is a real rare opportunity. It's not a complaint for me. As I said, you take the opportunity that's being given to you and buy stock rather than complain. I can fully understand why that's the case, because what I explained earlier, it's relatively new here, and we have to prove and show these numbers over time. But as David says, it's very exciting space to be in at this particular point.
Thank you, Robert and David. So let me have a few questions now for David. The new builds look like a big bet, and the market never likes uncontracted steel. So why is it wrong in this instance, or what can you do to mitigate the risks?
Yeah, it's a very good question, Nicholas, and I would say that is one that we have received at many occasions. The wounds, which we don't underestimate, of the overbuilding in ultra-deep water offshore energy, and the fact that there is idiosyncrasies in our tonnage, I run very deep. But I think, as Robert mentioned, this is really the opportunity because of where we think we can order these vessels, the price we can achieve and have achieved for them, which you think is already in the money. And I guess in some ways, like all stories, it's not quite as simple as that. If you look at the vessel demand profile, it is very, very clear that you'd have to travel a long way to find a subsector of this industry that has as much visibility as this. And as I said, it's not cyclical, It doesn't even actually have a random exogenous variable interfering with it, like, for example, the oil price. So whilst the contract term that we can achieve for these vessels is usually 6 to 12 months, and Sebastian can probably spend some more time talking about the details of those contracts, there are effectively two things that give us confidence and one thing that further consolidates the incumbency position. Firstly, as I mentioned, our top-down visibility here, we believe, is unrivaled. So whilst our contracts bottom-up might have short duration, our top-down approach to what we're doing, we have a very high degree of confidence in. We think that more than mitigates it. Secondly, you can tessellate these contracts to provide yourself with somewhere between 2, 3, 4, 5 years maybe of actual contract visibility. And bear in mind that these vessels, and we've laid this out on our corporate website, deliver cash on cash returns we believe to be at least high teens and prospectively into the 20%. Put differently, we have an asset payback which could be as short as 5 years on a cash on cash basis. And from that perspective, we think that the reward for the risk that you're articulating, Nicholas, around the contract structure is more than commensurate and more than appropriate for our shareholders. As a last point, I would say that and I'm going to describe it maybe slightly controversially as a myopia, but the obsession with long contract length is also in itself a barrier to entry. It's very difficult to find shall I say, sort of euphemistically, the Park Avenue types who will take the risk on a vessel which has relatively short contract profiles. And maybe they don't get as far as looking at the top down, which we think is as important, if not more so, around the demand profile for these vessels. It's apparent elsewhere in this industry. You've got fields, assets, and companies trading in the 25, 35, 40 times earnings range. And I think what probably people need to look at is, well, who's going to equip these turbines? What are they going to be able to charge for it? And how predictable are their cash flows against that backdrop of industry growth that is already priced in? So I don't diminish the question at all. I understand the concern and where it comes from. And as a very last point to it, I would say that when we ordered these tonnage back in March of last year, our first vessel, we were clear that we expected to have contract announcements within a year and a half of that ordering, which would see us announcing first contracts on the new build somewhere around the middle of this year. As Robert referenced, there's nothing in the growth profile of the industry that would cause us to move back from that remotely. And we continue to see both terms and rates strengthen in this industry against the backdrop of open tonnage moving into a predictable high growth market.
David, a question that just came in, and it's in line more or less with what we're talking about, is the vessel utilization forecast that you shared with us appears to be very encouraging. Do you see any risk for this utilization with the possible development of disruptive technology, such as the self-installing wind turbine, which is the subject right now of a pilot project funded by the UK government?
Look, I mean, I think, and a brief answer to your question is no. I think we feel very confident around our utilization projections. We even believe that there is some significant conservatism around the numbers that we've used. And I think the backdrop for that you can see from the presentation in terms of just the undersupply of vessels versus demand. I would say there are technical innovations coming all the time. And by the way, our new build vessels are part of that. But we do see a very long life for these vessels, both as the installed fleet of turbines grows. And as I said, in terms of opportunities around the world, there is no doubt that we're dealing with an industry which is high growth, high technology, and high innovation. That's an area we feel very comfortable in, and one where we think, as Robert referenced, the multiple that the stock currently endures, it does not reflect that in any sense. But I would say that the technology that the questioner identifies is one of several technologies that people are looking at to improve the performance of offshore wind. And the last point that I would make is all of these are moving offshore wind further down the cost curve, a more competitive, more durable, more cost-effective source of renewable energy. And that can only be good for an incumbent company in our position.
We have about 6 or 7 minutes left, but we have a lot of questions. So let me get to them quickly. One more for you, David. How is the new Seajacks and NETI merger progressing?
Well, we're delighted to have colleagues the caliber of Sebastian and his team join the company. It's early days. This is a company we bought only in August, but the initial signs, the backlog that Robert referenced, the profitability and the caliber of the people is really everything as good as we hoped. The fleet's operating in very good terms. We've announced fresh contracts since our acquisition. And it's great. It's incredible to have had the opportunity to bring a company like that onto the New York Stock Exchange right at this inflection moment in the industry. So very well in summary.
So have you seen the investor base evolve in the wake of a major equity placing last year?
Yeah, look, I mean, we have. I think, as I said, it's pretty difficult being a company in a one industry universe at the moment on the New York Stock Exchange. We spend a lot of our time in basically giving people a top-down view of the industry. I expect that to change. I mean, I do think there are significant investments in the wings in the US, and I think you will see more companies cluster onto the New York Stock Exchange. But for the time being, there's no doubt we exited dry bulk, and we remain a company that is building a register of people who want to access the growth and profitability that we believe is there, and our significant shareholders believe is there right the way out, as I mentioned, through to 2030 and beyond.
Sebastian, turning over to you, and I'll try to go through the question quickly. You are one of the most experienced executives in the space. So what major changes have you seen over your career so far? And even more so, what do you expect to happen from here on? And how is Eneti positioned to make these changes happen?
Thank you for the question. I think that David's referenced an inflection point in this industry a couple of times. And for me, what that means is for the last 10 or 15 years, this has been a two-dimensional regional Northwest Europe industry. And what's happened in the last 2 years is that it's become a global industry with regional markets, which creates opportunities for vessel owners. So when you were just talking about Europe, you could oversupply, there could have been an oversupply of vessels in that market. But you can move these vessels from one region to the other. And for instance, when we moved Scylla from Europe to Taiwan, we achieved a 40 to 50% increase in day rate from what the regional economics were in Europe. So, that is what I find very exciting, is this is more of a globalized three-dimensional industry, which has real growth ahead of it and opportunities. With regards to what else I've experienced in the industry, what I have been quite lucky to have experienced is actually to have been in an uptick, been in the boom time in 2011, where there was a shortage of vessels, and without going into the grisly details of it, we were far exceeding the 1,000-day rate for every million of capital invested, which is used as a basis point for the deepwater drill ships effectively. I think that Kraken and Leviathan were built for 115 million and our peak day rate was 180,000 a day. So when you get into the economics of these projects, we have experienced tight markets, and really with a strong track record and the ability to deliver efficiently for your client, that is a very valuable trait that you have, and that will continue to be valuable for the foreseeable future. And I think that that's what Seajacks and their operation, their organization bring to the Eneti story.
Last question for you, and then I'll go quickly to David. How is the customer base and geographic scope of operations changing?
Well, the customer base may be changing, but their demanding nature is not, right? So a lot of these Ørsteds and the big utilities are now they're in every regional market. But as was referenced earlier, I mean, for me, the barriers to entry are how efficient you install turbines. Our clients measure every single operation that we do to the nearest 15 minutes because the spread costs of them not being able, for every day of delay, they pay, I've heard figures of, $1 to $2 million a day in spread costs for ancillary equipment. So you're delaying other contractors, you have to, extend the storage facilities and what have you. And so every minute that you can save them saves a considerable amount of money. Basically, maybe not minute, but by the hour for sure, and definitely by the day. And that's really, while the global client base may be changing, their demands are not. In fact, their demands are getting more severe, and that is why the barriers to entry continue to grow.
Thank you. James, coming to you, the numbers here have to make sense. So what returns do you think are achievable in this space?
Good question. Well, the returns have to make sense, especially given the cost and complexity of the asset. However, it's through the cost and the complexity of the wind turbine vessel in the market that the returns are so attractive. So using what we consider to be conservative earnings assumptions, our new builds generate unlevered returns in the mid to high teens. And if you saw the supply demand graph in the presentation, or we're just listening to what Sebastian was saying, we're looking at a significantly undersupplied market, and one could make a case for higher returns.
So going more into the numbers, what is the correct balance sheet structure for the company?
Well, look, we've been in a process where we've been transforming Seajacks' balance sheet. When we acquired the company over the summer, we repaid their maturing bank debt and have been restructuring the liability side of the balance sheet since we came together. In the third quarter, we repaid our ING loan facility. So the total debt in the company is around 158 million. And this was inherited through Seajacks, and it has an interest rate of around 8%. So if you saw our equity offering filing, we announced a new loan facility for up to 175 million, which when completed will be used to repay the existing bank debt. It'll extend our maturities and cut our interest expense in half. So I guess to answer the question is, we're working towards it. We've done a bit, but there's still more to do.
So last question for you, James. What is special or interesting about the US offshore wind story? And isn't the political risk still too high?
Ooh, okay. Well, I think what's exciting about it is the base level you're starting at. As an American, there are thousands of turbines across Europe and Asia, and there's currently maybe 8 in the United States. And the US has a lot of coastline. So thinking about it from that perspective is extremely exciting. I think there's always going to be political risk. I don't think that changes. But I think, we're in a situation where we need to balance the global energy mix with new forms of energy. And similar today, that future energy mix is not going to come from one source. So I think it's going to have to be a combination. And I think that the US certainly has a lot of exciting opportunities here, which will come with political risk, but if do perform, will be a significant market.
Last question, we have exceeded our time. We have a Jones Act forum on February 25, and of course, we look forward to having Eneti with us. The question that came in is how much of an advantage is a fully Jones Act compliant vessel?
Can I just, from an operational point of view, I think it's a good analogy is that, we have used the alternative is feeder barges and a jack up to install off them. And that was used in Europe 10 years ago, and it was stopped being used as soon as self-propelled installation vessels came along because they're just a more efficient solution.
Well, I'd like to thank you. I don't know if anyone would like to give me, maybe David, some concluding remarks, or if Robert, and then.
Yeah, thank you, Nicholas, and thank you very much for having us. Thank you to everyone on this call for your interest in our story. We are entirely available to investors. We are delighted to have an opportunity to explain our approach. I realize there's a few questions we haven't been able to get around to today, but I would encourage you to come in through our investor relations page, and we are very grateful for your interest and delighted to have the opportunity to address those questions. And again, thank you to Nicholas and the Capital Link group for allowing us this opportunity.
Thank you very much to all of you, and just to remind everybody that this presentation will be available on demand for replay very soon. Thank you.
Thank you.